Hi guys, I'm going to do hopefully a very quick video on transfer pricing. Because I just want you to be able to connect transfer pricing with multinational corporations. You won't be asked an essay question directly on transfer pricing. It'll be part and parcel of multinational corporations and FDI. Okay, so it's really important. Like I said, macro is about linking all the different types of things we've done in the specification. Micro is very similar as well, but not as much as macro. So let's go into to this straight away. Okay, so transfer pricing is an accounting practice that represents the price that one division in a company charges another division for goods and services. Okay, so you have a main company, and what actually happens, you could set up a subsidiary. Okay, you have a main company where the tax is very high, and then you set up a subsidiary or an affiliate in a place where the tax rates are much more favorable. Okay, so transfer pricing can lead to tax savings for corporations through the tax authorities always contest this. Okay, so let's quickly briefly show you how this works. Okay, now if you have, let's assume you have Coca-Cola in USA. Okay, so you have Coca-Cola in the USA, um, or any company for that matter. Okay, so they're based here, A. Okay, so let's say the tax rate in USA is 35%. Okay, they decide to set up another company. They call it a subsidiary company. Okay, and that's B. And the tax rate here is 5%. So I guess you're already getting the picture now. Okay, let's suppose company A makes pre-tax profits of $1 million. Okay, so $1 million. Okay, they make pre-tax profits of $1 million. Okay, now they would normally pay $350,000. That would be their tax bill. Okay, but what this company decides to do is they say, look, we're going to set up B. Okay, and we're going to make this a very important subsidiary. We're going to pay this company, to take our intellectual property, to take all our patents, to take a lot of important goods and services and things like that. Okay, so you send everything over to B. Okay, the idea, what legislation is saying, you have to have what you call the golden rule. The golden rule, you have to have an arm's length. In other words, whatever price that B pays, okay, that is, well, A is selling it to B, you're paying B. Whatever price you pay them has to be the same price as any other company. So that's what they mean by an arm's length. You can't say this company is our company, we're going to pretend, and they're going to buy for 200,000. Okay, where it's worth a lot more than that. Okay, just because you want to use the money for something else. So they have to pay the fair price. It's very hard to try and determine that, especially when you have to get similar type of company, similar type of transaction. It becomes complicated. But the main thing, all you need to know is that this is a means, a way that multinational corporations reduce their tax bill. Okay, so in other words, if the transaction was to cost $800,000, okay, this company A would only be taxed on pre-tax profits of $200,000. Okay, so you can see straight away they would only be taxed on $200,000 rather than being taxed on 1 million, because they've already paid 800,000 to this company B, which is their company as well. So you can see it's kind of complicated. The main takeaway from this, okay, because like I said, they're not going to ask you a question directly on transfer pricing. It's going to be part and parcel of multinational corporation. Okay, the takeaway is that this is a way that corporations can reduce their tax bill. So let's quickly go on to, because like I said, it's linked to multinational corporations, and you have to learn how to link things multinational. Okay, so let's look at the advantages and disadvantages very quickly. Okay, what are some of the advantages? Is that for the wherever you base a domestic company, hopefully will get higher tax receipts, okay, which will help their budget deficit. So that's one of the benefits, presumably. Another benefit is that it will create jobs. Jobs will be created. Okay. Another benefit is that in developing nations, it can improve standard of living. Standard of living. Another benefit is that it can give economic growth through investment. Investment's a component of aggregate demand, so it should be able to increase aggregate demand. Okay, so those are some of the benefits of multinational corporations. Now, on the downside, some of the negatives on the downside, well, first of all, is transfer pricing. Okay, they tend not to define clever means of reducing their tax liability. So transfer pricing, that is a problem. Transfer pricing. So that's a negative, okay? Because they always find ways of taking out a lot of their revenue. So the domestic company can't get much of their revenue because these companies always Google, Starbucks, all of them, they all they all use transfer pricing, or every one of them. So it's very difficult to hold them down and be able to tax. Remember, one of the benefits is supposed to improve your deficit, your budget deficit. But when you use transfer pricing, a lot of the proceeds is already taken out of the country. Okay, so that's one problem. Another problem on the other side is environmental considerations. Developing countries want to have multinational corporations coming in. So the multinational corporations like it because some of the environmental regulations are not as tight as developed countries. So they can go in there and basically have the freedom of the city, as you can say. So that is a problem. And then obviously there's accusations that there's exploitation of workers. Okay, so you have environmental, and exploitation of workers. Exploitation of workers. And we can carry on. I mean, we can debate this, but the key point here, guys, is that sorry, the page looks a little bit messy, but transfer pricing really is part and parcel of multinational corporations, okay, and FDI as well. So you look at transfer pricing in a whole big aspect, not just individually. Okay, remember transfer pricing. Basically, the takeaway is transfer pricing is a means in which multinational corporations can reduce their tax liability by setting up a subsidiary company and by transferring goods and services over to them, where there's a much lower tax rate in that particular nation. The authorities try to reduce it by having the golden rule, which you have to have arm's length, but they find clever ways of getting around this. So just need to be aware of that. So when you're in your essay, that's where transfer pricing comes in. So make sure you read this, not read it, make sure you watch this video because you're likely to get some questions on this. Okay? Thank you. See you later.